Hey there. Hope everyone's doing well. Wanted to take a quick minute to share this graph, this visual aid that was sent to me by one of the members of the RTD community. And so it was in reference to how interest rates, usually don't work. And so after looking at this, I agree 100%, but I also wanted to add a couple things on top of it, which I think can help people better understand this visual aid right here and better understand how we've arrived at the current point where we're at right now. Once again, at or near all-time highs due to the artificial nature of this current monetary system that we're in. Is based upon debt and easy credit that leads to malinvestments that creates bubbles that end up popping. And as they pop, the only thing that tend to be the ideal solution is to cut rates. And so, for those that pay attention to the mainstream news, that's what the narrative is now. Will the Fed cut? When will the Fed cuts? And so, more and more people, economists, and all the people who are in the know, they're preparing for and betting and waiting on the Fed to cut sometime in 2019. And so, as you guys see from this visual aid right here at the very far right, this is the S&P 500, the largest cap index for United States of America. So this is pretty much a good indication of the top 500 or so corporations. But yet here we have visual aid here, and as of the last couple of weeks or so, give or take, there's been a slight dip to the far right to where things are seeming to adjust themselves or correct to what some people might consider fair market value. But as you see, as you look to the left of this screen, every type of crisis or recession or market slowdown or global slowdown, the result were cuts. And so from 2000 with the dot-com, 2007, '08 with the Great Recession aspect of the banking sector, we see what happened with that. But most people don't really realize what all took place. So I'm about to go to a different screen to show you exactly some of the chain of events that took place to then come back to this and be able to explain it a little bit better. Here's a timeline here of the Great Recession. So this article here is from 2013, kind of at the tail end of all the chaos that ensued in the midst of those QE processes that were unleashed as a result of those dips in the interest rates. So give you an idea what's going on here. Just this little piece here says the Great Recession of 2008 didn't just happen in 1 month. It took years to correct the easy money policies and lax standards of Wall Street. This timeline gives a blow-by-blow account of how the Great Recession unfolded and how the government and the banking industry responded. So what I found interesting about this is when I just typed in how many interest rates did the Federal Reserve take, it brought me to this article here. So it actually walks us through from the time where things were considered good. And so if you guys have been paying attention, as I'm sure you have, you've been hearing a lot about great economic expansion, Trump touting how high the stock market is, Dow Jones is this, that, whatever. But yet, once again, all presidents kind of go through the same narrative before there's a major crash or something or a correction. So here we have 2007. It says Freddie tightens standards. Dow hits all-time high. So let's start right there. Into 2007, Dow hits all-time high. We've heard the word all-time highs in reference to our current equities markets quite often now. And it says 2008, Bush signs tax stimulus. Fed bails out Bear Stearns. So this is when everything hits the fan. Countrywide sold to Bank of America. Bush signed homeowner aid bill. We got Bank of America buys out Merrill. Lehman's fold. Fed bails out AIG. SEC suspends short selling. Partial sale of Morgan Stanley. Congress loans Big Three $25 billion. Wells buy Wachovia. Treasury puts $125 billion into banks. PNC buys National City. Treasury buys into ANG. Insurance firm seeks TARP help out. Fed begins quantitative easing 1. The official, see where it says here? The official recession declared. So once again, here we are toward, I'm not sure what time frame this is in 2008, but we got all this activity, all these corporations failing, all these people being bailed out and buying each other. All these too big to fail banks helping each other out by trying to take on the debt obligations of other corporations or other banks by buying them, probably very, very cheaply. So we got all this chaos here. So I'm not sure what time frame this is, but we're well into the chaos. But then here we have the official recession declared, according to the Bureau, whoever, I forgot off the top of my head who labels it. But we're already in the midst of chaos. All this QE stuff being announced. Now recession is announced. So that's another thing. Be careful waiting for the official announcement of a recession, because as you see from this prior Great Recession, we were well into all this chaotic chaos in the financial sector before it was official. But then it just said Fed cuts key rate to near zero. So in 2008, the Fed cuts key rate to near zero. Bush signs loan for the big three. GMAC bank bailed out. 2009, Fed begins buying agency MBS. Obama unveils borrow relief. Fed intro bank stress test. Fannie reports 58.7 billion loss. Dow hits 12-year low. So as you guys saw from the very top of this screen here, 2007, Dow was at all-time high. I'm sure everybody was celebrating. Everybody felt rich. But yet in the midst of this chaos, it hits a 12-year low. And then goes on and on and on and on. End of QE1, Dodd-Frank, QE2. So here we have all this information here that ties into what I'm talking about in reference to the interest rates being cut and how that was proposed as being the solution. And that's how things have been done in the past. But in my opinion, I don't think that's going to be the case this next go round. So here we are, back to the main screen here, where we see from 2007, where the Dow hit the all-time highs, and this is the S&P at an all-time relatively high at that time frame. And we see once the recession hit, we were already well into the end of 2008, which is towards the very bottom where the S&P had already dropped significantly and the panic has ensued, and government and the central bank began dropping rates. So here it was approximately 10 rate cuts. And so I'm going to show another graph in a minute to show you how much was cut off. And so it's around, say, 6% was the average Fed interest rate at that particular time, which gave them a little wiggle room to be able to drop it, as it said in that article, to near zero or almost at zero. But yet, going back to the dot-com bubble at 2000, 2003, it was around 4 or 5% as well. So it gave them some wiggle room to be able to dip and drop. And then by dropping, is what I'm getting at, by dropping the dot-com Fed rate, by them dropping, it looks like he says here 13 times, it created a somewhat low environment, which spurred people to take on debt, which encouraged people to go out and borrow to then basically prop this thing and get this thing back inflated, which led to, as we all know, the housing boom that came to a bust, as well as all the mortgage-backed securities and all that stuff that was borrowed into existence from debt, which led to the Great Recession. And then as everything began to crash, as we saw in the midst of everything, it was officially announced. But we already saw, I'm sure a lot of people felt as they were being foreclosed on and everything of that nature, losing countless amounts of money in their portfolios. But then it was officially announced. And so what I'm getting to now is, look at where we at now. Look to the right of the screen. So from the all-time lows of what it looks like in 2009 at about 700 to where we just currently came from, about 2,900. Think about what's going to happen next. How much worse this thing stands to become. And the fact is, we're nowhere near, or the Fed's nowhere near able to cut interest rates the way they have in the prior two recessions. And so from cutting, it spurred on malinvestment, which then created a bubble of the dot-com time frame. It popped. Then we had some cheap interest rates, no interest rates, funny money being created out of nowhere, led to the Great Recession, and then it popped. And here we are now in what could be the biggest, most dangerous financial bubble asset timeframes in human history, more than likely, because it goes well beyond my current knowledge base. But just being able to read and to decipher these type of graphs here lets me know that this next drop will not be pretty. And so this next graph, I'm going to show you why it won't be pretty, because there's nowhere to cut. There's nothing to cut right now. So here we have the actual chart. Fed's fund rate from 2000 up into this current point right now. And so as you guys can see, if you go back to 2000, 2007, 2008, you can see there was something to cut from. 6%-ish back in 2000, 5 3/4, give or take, in 2007, 2008. But if you look at where we're at right now, we're barely at 2 1/4. And that's been a problem in and of itself because of how prolonged this zero interest rate policy has been basically from going to zero and back in 08, 09 time frame up into 2015, 16-ish. This current 10-year expansion that we're in is not really an expansion. It's been the creation of the greatest bubble in human history because it puts the world in a very dangerous position because as of now, if it took 13 rates cuts back in 2007, 2008, and it took 10 rate cuts, give or take, in 2000, this next recession will not be announced until things already are crashing. But then at that point, what can you cut? So if they cut, they will definitely go below zero. And then once you go below zero, all bets are off because according to my knowledge, we've never gone that low. And what it look like, who knows? But I can guarantee you it won't be pretty for those that have no awareness and depend upon this current financial system to protect, preserve, and to keep their wealth as it is, nevertheless, for it to grow in a zero or negative interest rate type of environment. So to sum this up real quick, I want to show you this last visual aid where I put the first graph with the rate cuts and the S&P rather on top of this one. So you can see exactly how it correlates very well. And it should be very alarming to those that are able to see through both of these graphs here. And it don't take much to guess at how bad things will be, probably a lot sooner than we think. So here's the very last visual aid I want to share with you guys. And this is both of those S&P and the Fed funds rate on top of each other. And as you can see exactly what I'm talking about in 2000 area where 13 rate cuts took place, it took it from about 6%-ish or a little bit above 6 down to maybe 2 or 1.75, give or take, which spurred on more borrowing, which then led to the housing boom, which was the 2007, 2008 timeframe. And then from that, when that bubble burst, it took that from 5.75, give or take, all the way down to zero. And so if you look between 08, 09, and 2010, rather, at the very middle of the screen here, you'll see where all the artificial nature began. And from that point on, that's when the true economy died. That's where capitalism, the way the world had knew it prior to, ended. Because from this point on, at the middle of the screen, when the S&P was down at its all-time low, and then the Federal Reserve responded by dropping low rates to its all-time low at zero, that's when, in my opinion, the Federal Reserve note, aka the dollar, became a weapon. Because from that point on, everything else was propping up this system artificially through just funny money creation, spurred on by 0% interest rates, which then led to more borrowing than I can ever imagine or the world probably has ever seen before. And so that has led to everything that's happening now, the de-dollarization process, China, Russia, everybody up in their game, getting their weight up and doing what they're doing because they know this doesn't end well. And not only do they have their own problems, but this screen right here is a good indicator of what will happen that will lead the way around this planet. And so here we have the S&P from all this zero interest rate policy, which created the biggest S&P equities bubble, and the Dow would correlate very well with this as well, to where it's not artificial. So those gains aren't real. They're debt induced. Therefore, once again, all that debt must be accounted for, must be reconciled, must be paid back in some form or fashion. And so that's not possible. So what's going to happen is, in my prediction, my honest, humble opinion, just like the prior two recessions led to major corrections, this next one will definitely drop below this zero or damn near it. And then when they cut rates to try to prop it up, that's when, in my opinion, there will be a shift in our current monetary paradigm. Because between now and that time, whenever that time frame is, life after that time frame, I don't think we're going to recognize it in the way we have this prior 10 years for sure of economic artificial expansion. Nevertheless, during the earlier years and in between these recessions, just to the left of the screen. So this is what's happening. I thought I would just add a little bit on top of it. But more important, as always, if you see all this happening in the paper and in the digital realm, these are all just basically central banking manipulation spurred on by the government indebtedness and dependence upon the central bank, keeping this system propped up, and they do it through our national currency. So if you know all that, then I'm sure you're more than aware of the importance of getting your weight up, diversifying, and just taking action for yourself. Because once again, this game right here we're watching, it's rigged against us. And I don't think there'll be no winners according to their rules. So you must play by your own rules, which means educating yourself, getting your weight up, and going from there. So as always, I want to make sure I inform you guys who do not know about this, about the RTD Scary George coin, a great way to get your weight up. In the midst of seeing all this, it's an option to get outside of a system that's rigged against you, and so that you can take possession of something that belongs to you, that you yourself can hold, and it will preserve and retain value because of the monetary nature of it and the fact it's scarce and all that good stuff behind it. So just definitely want to point you guys to the Scary George coin. Other than that, you can find the information for that if you're interested beneath this video. But other than that, look forward to hearing your thoughts on this, and I will see you guys later. Peace.